You're about to join Jerry Parker, Moritz Siebert, and Niels Larson on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Moritz Siebert and I, Niels Larson, are back with this week's edition of the Systematic Investor Series, which is our weekly ongoing raw exploration of the world of rules-based investing. And of course, where we also try to take some of your questions. But today we're going to deviate a bit from our usual format because we are delighted to be joined by a very special guest, namely Robert Carver, who couldn't have come at a better time to discuss the pros and cons of rules-based investing. So let me start by saying welcome back to the show, Rob. It's been a while.
It has been. I think it's been about 4 years. So yeah, it's really good to be back on.
Definitely. Yeah, great to have you. And of course, Moritz, good afternoon to you. How are you doing?
Hey, I'm doing great. Good afternoon, Niels. Hello, Rob. Great to have you with us today.
Thanks, Moritz.
Now, we have a lot of things to talk to you about, Rob, but since we usually do a quick run-through of the week in terms of what took place inside the trend-following portfolios that we work with, maybe I can suggest that you grab an extra cup of coffee while Moritz and I just do a quick run-through, and when we'll be straight back just talking with you about all things systematic trading, I guess. So, quick run through from me. I mean, of course, it was a historic week that just came to an end in terms of market moves. Not seen since the financial crisis, and some one-day moves not seen since the stock market crash in 1987. Despite a very strong finish on Wall Street yesterday, US stocks still managed to finish down between 10 and 17%, depending on which index you look at for the week. German stocks finished down 17% for the week. And during the worst moments of the week, many of the world's equity markets had given up multiple years of return in only about 3 weeks. So, but these weren't even the biggest moves of the week because it all started as energy took center stage on Monday when it recorded a drop of 30% at the open. It finished the week around 20% down for the week, so not as bad as we saw initially. And if that wasn't enough, typical safe havens like gold and US Treasury also got sold towards the end of the week as investors were scrambling to raise cash. The dollar did find some level of bid towards the end of the week after having been sold off as carry trades got unwound during the first part of the week. And of course, the big winner was, at least in terms of price increase, one of few markets that did go up in price. That was the VIX index. But before we move on to you, Moritz, I just want to say one thing, which I'm not an expert. I want to admit that straight from the beginning here. But it's something that is not getting a lot of press, and I don't know if it's really important. But this week, and I think it was Thursday, the Fed provided an unprecedented $500 billion in the largest ever overnight lending program. And usually that is linked to some kind of bank or group of banks being in trouble. Just as putting it into context, the discount program, as it was called, or window, as it was called back under the financial crisis in 2008, when Bear Stearns got in trouble, they provided $50 billion. So now we have a week where they just did 10 times Bear Stearns. I don't know what it means, but I think it's important. So with that happy news, Moritz, how was your week?
Very interesting week. What a week. I mean, you need to tell me when I should stop because I could speak, I could do a solo speak for an hour about this past week. I mean, we had the oil market plunging, limit down on Monday. We've had the S&P limit up and down a couple of times this week. Markets very volatile all over across the board. I've lost 1.5% in my trend following portfolio, and I must say I'm kind of happy with that. I'm very happy that I'm not just long equities, buy and hold, buy and hope. I probably would have thrown in the towel. I mean, those moves, I'm sure a lot of people who are exposed to equities too much, they probably puked and they'll find it very, very stressful to hold on to that stuff. So difficult week. But year to date, 16 basis points positive. That doesn't mean a thing. That's kind of like a 5-second P&L for us. That may change on Monday in a heartbeat. And lots of positions that I exited off and new entries, mostly on the short side, that I took on this past week. Made money, obviously, from being short oil, as we all did. But the bonds didn't help this week. Still long the bonds, pretty heavily long the bonds, but they didn't provide the anti-correlation, which they usually do during times like these. I mean, they did the week before, but they didn't do this week. And then kind of like flat on the equities now. Some long still, some shorts. Aussie dollar has been a great short this past week. Bitcoin. We have to mention Bitcoin, right? I said it, like I have a couple of Bitcoin, which I like hold, spot Bitcoin. This is outside of my trend following portfolio, but I must say my tummy is turning because I got an entry signal to short Bitcoin futures, the CME Bitcoin futures. And so there you have it. This is probably going to be a roller coaster ride. And but look, it's the rule. Take the position, appropriately size, see what happens. So there we go.
No, absolutely well done. Now, people might be surprised when I say that for us, this week was pretty uneventful. Volatility was very small on a day-by-day basis, typically plus minus 1%. We made money this week, a decent amount, not spectacular, but we made a few percent. And so not that we're going to spend time on it now, we're going to get to Rob and talk about this, but this is some of the differences we've been talking about for weeks or months or years on the podcast when we debate, how risk management can be done differently. Because in our case, it's always done from a very statistical point of view on the whole portfolio. And in a situation like this, where you have lots of volatility and actually correlations increasing between markets, this is where we become very defensive in our positioning, as well as triggering some a lot of exits, which we talked about last week in the equity part of the portfolio. So this week, good week, flattish on the year, like you, Moritz. But coming back from a down month in February. Interesting markets that did well for us this week. Australian dollar, as you mentioned, volatility. We have a small volatility component. Obviously, that was interesting to see how that coped, but it did well. Lean hogs, crude oil. So a lot of breadth to have these type of markets provide a bit of positivity in the portfolio. Things that didn't do so well, a little bit on the equity side, of course. 10-year Australian bonds didn't do so well for us. Nat gas, gold, but again, overall, pretty uneventful, if you can put it like that, and obviously, very little risk overall in the portfolio. But enough about that. This is much more important, and that is to get to you, Rob, because, it's been a few years, as we talked about. You've been on the podcast, which, by the way, was a hugely educational conversation, as I recall it. So I highly recommend anyone listening to us today to go back and replay these episodes, which are the TTU series, episode 89 and 90. But what is also interesting is that when we had our conversation, one of the things we talked about was your first book, Systematic Trading. And I think, got you to read a part of the beginning, because it all kind of takes a beginning in terms of you describing what took place back in early 2009 at the height of the financial crisis. And it clearly illustrated, the difficult, stressful periods in the markets and how difficult it was for you to make good decisions. And I think last week, or the last couple of weeks, is easily at the same scale in terms of uncertainty in the market. So I would love for you to start out by telling a little bit about, going back to 2009 and the challenges you faced back then, and how that contrasts to the past week or two in terms of how you've dealt with it, and dealt with the volatility, from that point of view.
Yeah, I mean, it's interesting because a lot of people have been making comparisons between now and 2008-9, which, is obvious because it's the last crisis that most of us can remember. But this is quite a different crisis. So in the kind of fancy language of economists, I think you could describe 2008 as an endogenous crisis. So the kind of stress came from within the system. The kind of financial system became over-leveraged, and ultimately that was always going to lead to its downfall. And the actual way that things played out in the markets happened relatively slowly. I mean, we had the first kind of stress of the hedge funds linked to Bear Stearns in kind of February 2007, and that was probably the first kind of indication that things were starting to crack. And then we had bank runs in the UK later that year. Although interestingly, if you look at the equity market, it kind of held its value fairly well until obviously mid-2008 when it did start to plunge. But even then, looking at how the equity market sold off in late 2008 and comparing it to what's happened over the last few weeks, the acceleration and the speed of the downturn that we've seen in the last few weeks has been phenomenally faster. I said to you guys before we started speaking that a few weeks ago I was on a skiing holiday in northern Italy and everything was fine. And I think the S&P probably hit a record high around that time. And now we are a few weeks later and we've seen these savage moves come almost out of nowhere. So in many ways it has been quite a different crisis because it's come from outside and it's affected the markets much more quickly, and the speed of the downturns has been much quicker. That does mean that some of the things that you kind of hope will happen in a crisis as a trend follower haven't necessarily happened. So you in 2008 the sell-off was slow enough that most CTAs were able to get short equities and long bonds and therefore deliver very good returns in kind of Q3 and Q4 of 2008. And listening to you guys just now, you're kind of like, well, we're kind of flat, small down. In my own kind of trend following portfolio, I'm small up. It's not what you'd expect, which is this kind of quote unquote crisis alpha, right? It's not the big outsized negative correlation to equities that you'd hope to get, this sort of insurance policy effect. So it's all very well going back to 2008, but actually this does feel like something quite different.
Yeah, no, I mean, not to interrupt your flow here, but I would say, it's interesting what you bring up here, but to me, we're 3 weeks into the crisis. And actually, when we go back and if I look at the two largest drawdowns in the MSCI World Index, which was, of course, the .com bubble and the financial crisis, those two crises are quite interesting. Because if I look on our side, our own performance, one of the crises, we start making money straight away. And this is on monthly data, right? Not daily data, but on monthly data, we start making money straight away. The other one, it took us a few months before we started making the money from when the equity market hit the high and went into its drawdown. But we ended up making more money at the end of the drawdown for the equity. So for me, the last 3 weeks is, yes, it's a crisis because of what's happened, but this is just, if this is a real crisis, this is just the beginning, meaning from a trend following point of view, I don't expect anyone, except for the short-term guys, to have designed systems to make money from this 3-week period or 2-week period. It's for the next 18 months or so, we're going to show that non-correlation or negative correlation, ideally, if it continues. So I just want to put that in because I don't want to make it sound like that we would be expected to make money when something like this happens. I don't think necessarily trend followers can do that from a design point of view.
That's exactly the point I was trying to make, I guess. I think what you're going to see over the next few days is articles in the financial press saying, oh my goodness, CTAs, which are supposed to deliver this crisis alpha, haven't done that. They're probably on average, the index is going to be flat for last week. And I think we need to reinforce the point that there's a very good reason for that, which is the speed we've seen. I did a couple of quick kind of back of the envelope exercises this morning before we started. One was to use a very simple moving average crossover, 16 and 64 days on the S&P 500. And that crossover went kind of flat on, I think, something like March the 3rd. So, before that it would have been long. And then this week, it would have been short, but it's only just crossed over. So the size of the position, before we even talk about vol scaling, would have been very, very modest. So, most people would not have been significantly short equities last week, I would say, based on that. And the other thing I did was just look at the performance of my own portfolio on a day-by-day basis against the S&P 500. And it looked to me, just by eye, this is not a quantitative exercise by any means, but just by eye, it looked like I went from having kind of a long beta to S&P 500. In other words, on a day-by-day basis, when the S&P 500 was making money, so was I, to having a sort of short, a negative beta around the same time. But the magnitude of the beta was small. So, as things stand today, I'm kind of net across my whole portfolio. I've got a net negative exposure to the S&P 500. Not necessarily because I have a short in the S&P 500. I don't, as it happens. I'm flat, like you said. But the exposure overall kind of gives that effect. But it's not a big short. It's still quite modest. And you're right. If things continue to play out, then I would expect that negative beta to increase, and I would expect the crisis alpha to come in. But I think being flat last week isn't bad. It's not a bad outcome, to be honest.
No.
As trend followers, we're always at the risk of the whipsaw, right? And just because of the speed that we just had, maybe that whipsaw risk is pretty elevated these days. I just mentioned the short Bitcoin. I mean, you're getting short Bitcoin below 5,000, and maybe the thing's going to be trading at 10,000 by the end of next week. We don't know. Maybe equities will have a massive reversal. But like you say, Niels, maybe it goes the other way and those trends continue and it does deteriorate from here. We don't have that crystal ball, but the whipsaw risk is definitely there, and it's pretty high.
Yeah, and also, when you design portfolios, obviously we're going to get into portfolio construction from your point of view, Rob. But when you, as an investor, are trying to design a portfolio of CTAs, I mean, you don't want every one of your CTAs or trend followers to be the same, right? You want some of those short-term guys who would have done or should have done really well this week because it was their environment, and then you want some medium-term and maybe some long-term guys that will then carry the torch, so to speak, as the crisis or as the trends continue, and where daily volatility may not, be stopping you up and whipsawing you. So it's all about true, in my opinion, true diversification across, different things, of course, from a portfolio level, but within the CTA space, different types of strategies, and really work out what drives the performance of each manager that you engage with. And actually, what just to stay on that topic for 5 seconds more, and that is, I think one of the mistakes that people have made in recent past is that they look at the performance of trend followers and say, oh, they're all very highly correlated, so they must be doing the same thing. But a period like this will show you that no, just because you're highly correlated doesn't mean your returns are correlated. They can be very, very different. So this is actually a great time to learn. I want to be respectful because I think a lot of people lost a lot of money in the last couple of weeks. I don't want to make it sound like we're smug and we're happy that this happened. But it's just a learning experience that is very important for everyone to internalize and study and as the saying goes, I mean, we learn the best from the biggest challenges we face, and I think this for investors will be one of the biggest challenges that they have faced in a long time. And let's not forget one thing, and that is a lot of the people sitting on the trading floors today, many of them has never experienced the financial crisis. They have never seen volatility like we saw the last, few days. That also plays a factor in all of this. So, but why don't we I'm sure we'll come back to this week's events, but maybe from a big picture point of view. I mentioned your first book, which we talked a lot about in our first conversation many years ago, Rob. You also wrote a book about called Smart Portfolios, and you start out with a quote from Harry Markowitz where it says, "I only have one piece of advice: diversify. And if I had to offer a second piece of advice, it would be remember that the future will not necessarily be like the past. Therefore, we should diversify." So diversification, I would love to just dive into this. Talk to me about how you think about diversification. What does it really mean to you to be diversified? Because I think we all have our own different interpretations of what that is.
I mean, the basic maths behind diversification is that obviously you're trying to hold assets which are uncorrelated. And that means that the average risk of your portfolio would be lower than it otherwise would be. The nice thing then is that as we're all people trading futures, we can leverage up to hit a given risk target and basically earn that diversification in the form of extra returns, which is obviously what the investor ultimately wants. Now, there's a kind of a few issues with the statement I've just made, and one is that this idea that correlation is a good measure of diversification, because correlation is a linear measure. So it kind of assumes that assets always have the same relationship. So generally speaking, if assets are negatively correlated, that means that all the time, if one asset goes down, the other one should go up, and vice versa. And we can kind of bring this to the present day, because last week, we saw what tends to happen in a crisis, which is that correlation patterns change, and they change very quickly. For quite a long time now, there's been a negative correlation between stocks and bonds. And last week, we saw on some days at least that relationship breaking down, and actually bonds selling off when that's not what the correlation would have expected. And we don't really know why that happened. I mean, we can speculate about it could be just a general deleveraging. It could be that a lot of people now are running risk parity funds, which means that they have to deleverage their equities and their bonds at the same time. It could be related to the rise of passive investing, and now there are a lot more ETFs in the market. We don't really know, and it's not necessarily a profitable activity to speculate as to why these correlations are breaking down. It's just important that we need to know that they are. So for me, at least, the lesson there is that you've got to view diversification with a kind of as wide a view as possible. It can't just be about having both stocks and bonds long only in your portfolio, because probably 80% of the time, that will be the right thing to do. They will be negatively correlated, or at least low positive correlation, and you will get a nice diversification benefit from that. But we talked about not being smug about people losing money, so I have got a long only bond and equity portfolio as well as a futures portfolio, and that did pretty badly last week. It certainly wasn't flat. So that goes to show that this very limited view of diversification that a lot of people have, you really have to go beyond that. So I like to think of diversification across a number of different axes. And the first is sort of style. What style of investing you're doing. So we're all, I guess, to one extent or another, kind of trend followers. So that's a bucket that we kind of fit into. I think we're all probably big fans of trend following, but does that mean that we would advocate putting all of your money into that single style bucket? I certainly, from my perspective, no, and I'm sure you guys agree. For most people, trend following is something that they add to their existing portfolio because they like the properties that it brings in terms of added diversification. But there's almost nobody out there who puts all of their money into trend following. So you obviously got trend following. You've got other styles like value. You've got styles like short volatility. These are all, I guess, sources of different kind of risk premia that as investors we want to collect. So there's another way of thinking about the styles is essentially that there's a whole bunch of risk premia out there, Again, the fancy description for them is that they're latent risk premia, so we can't actually see them or measure them directly, but we know that there are certain kinds of assets and certain kinds of trading styles that give us access to those. And you really want to have a wide variety of these risk premia, because when things go really badly and diversification rises amongst the kind of long-only portfolio, you've got a better chance of surviving if you've got these other things in your portfolio as well. So the styles, that's the kind of top level, and then obviously you've got asset classes. The nice thing that as futures traders is we can go beyond stocks and bonds. We can go into commodities. We can even go into Bitcoin if we're brave, although I'm not that brave, Moritz, I have to say. Not as brave as you. And then obviously within asset classes as well, you really want to have a geographical diversification. And this really fights against kind of one of the most well-known psychological biases in the industry, which is the idea of home bias. People just prefer to own stocks in their own country. And I guess as someone who was an Italian investor and seeing, the MIB index down, I think close to 20% on a single day, that's someone who really would have benefited from having a much wider diversification across countries than just focusing on one country. So, and then of course, we can dive even deeper into diversifying across industry sectors in equities and so on. And one of the main points I make in the book Smart Portfolios is that diversification is kind of a something where there's diminishing returns. So there's a huge benefit from starting with a long-only portfolio and then adding, say, trend following to it. By the time you get down to the level where you're deciding whether you should buy your fifth kind of US oil company, and you've already got four, the kind of expected benefit from that is pretty small. And that's why, one of these truisms in the industry is that getting your asset allocation right is more important than perhaps your stock selection. But I'd even go to the kind of level above that and say getting a good exposure to diversified sources of risk premia is perhaps even more important than asset allocation.
I want to say something, Moritz. Just sorry to interrupt you here. Just a couple of things. One is I like your top-down view on diversification. We actually had a listener not long ago, and who talked about, he was a consultant to a lot of pensions, I think, and he was just basically dividing and asking people, so, what's your diversification versus, between convergent strategies and divergent strategies, right? And for those people who may not be familiar with that, but basically convergent strategies are things that tend to prefer stable markets, and divergent is strategies that likes change, like trend following. And what he found was that most people had like 90% or more in the convergent bucket. So thinking about your portfolio in these terms is super helpful. The other point I wanted to make is just about the correlation you mentioned, the breakdown of correlation between bonds and equities, because of course risk parity strategies have become so popular. And it's absolutely true that there has been this nice negative correlation for the past 10, 12 years for most days between stocks and bonds. However, we shouldn't forget that if you go back 50 years or 100 years, the normal correlation between stocks and bonds is actually positive 66% of the time. So this is another danger zone that I think we have to really be aware of. And then back to something that Moritz and I have talked about, and it could be what you wanted to bring up, Moritz, I don't know. But we've been talking about this point about, in our trend following portfolio, should we just keep adding markets, right? Or when is enough in terms of markets? Because on our side, we trade only 55 markets. And I know Moritz trades a lot more, and Jerry for that matter. So we've always had this little bit of a debate where we need a kind of an independent ref to come and talk to us about it. So maybe, Rob, that's what you need to do today about, where's the limit within trend following portfolios in terms of just adding markets?
You are the referee. I mean, just because we just touched on the MIP lost close to 24% this past week. The DAX is down 20%. And I'd say the reason I'm not down 10% or 20% is because my portfolio is so diversified. It's diversified across markets. It's diversified across timeframes and systems. It's diversified across long and short positions, right? There's stuff in there that's just independent, just by eyeballing it, rapeseed and crude oil and Bitcoin and equities and all of that stuff. And it is really my belief, it's one of those things that has been instilled in my brain, kind of like chiseled in, that I'm not giving up, is diversification is the only free lunch that you can harvest out there. And there is a diversification benefit that you can get from every market that you're adding to a portfolio that does not show perfect and perfectly stable correlation to any of the other markets, right? Now, that benefit mathematically gets smaller the more assets you add to the portfolio. But that being said, even though the marginal benefit gets smaller, it's still a positive benefit. And so my belief really is that from a risk-adjusted return perspective, if I'm trading as many markets as I can, if they don't have perfect correlation, then I should get better risk-adjusted returns. And I'm a bit puzzled by, we've heard some people from the industry say, and the name shall stay unmentioned, that, oh, no, we've started to reduce positions. We've started to reduce markets, not positions, but markets in our portfolio. We're back from, we maybe say we had 100, now we're at 70, we're going to 50, because we want to have more conviction in certain positions, and they're kind of like showing the same trends anyway. And I say, no, this is wrong. I'm not moving on that. So you're the referee on that, Rob.
Okay, the referee is ready to make his decision.
Well, I will just say before you do that, Rob, I may have a few other points than than Moritz before. But anyways, I'll let you talk.
Yeah.
I'll let you talk.
I would say that Moritz is theoretically correct, but from a practical perspective, he may not be right. So I agree with you that every market you add will add a small amount of performance to your portfolio, and that the benefit will obviously reduce over time. So I'm trading about 35 markets. I would definitely like to trade more than that, absolutely. And the reason I can't is because I'm just trading my own money, so I've got relatively limited capital. So that's the first kind of practical reason why you can't necessarily trade as many markets as you would like. So if I could be permitted to plug my latest book, which is called Leverage Trading.
Of course.
And a lot of the time I spend in that book it's really aimed at retail traders with relatively little capital. And I spend a lot of time asking the question, if you've got limited capital, what is the best use you can make of it? And the kind of first thing I say is, look, if you have enough capital to trade, to add an extra market to your portfolio, then almost certainly that is what you should do, because you're going to see a benefit that'll be larger than doing almost anything else with that extra money. So if you have a large amount of capital, and I'm saying hundreds of millions, if not billions now, then it's quite likely that you will be able to add quite a lot of markets. There is a cost as a business to having extra markets, and this is kind of interesting because when I was working for AHL, I do remember having a conversation with the chief operating officer of the fund, and he called me into his office and he says, "Look, I notice you've decided to add another 45 markets to this fund. Some of them are going to have very small allocations. The expected return is going to be quite small." And I put on my Moritz hat and I said, well, yes, but it will be positive in the expectation. So we should absolutely do this. From the client's perspective, this is the right thing to do. And he said, well, yes, but from our perspective as a business, is it the right thing to do? Because there's sort of a fixed cost to adding each of these markets. And at some point, the fixed cost is going to be greater than what we could realistically expect to earn from kind of higher management and performance fees. So that was kind of interesting. That was a classic kind of incentive conflict between the client and the manager. What was best for the client wasn't necessarily best for the manager. I think there is a compromise. So if I can get you guys to talk to each other again and get out of this fight.
No, I'll tell you one thing before you get the compromise, because this is important.
Yeah.
Because I've said to both Moritz and Jerry that it's not that I disagree about adding more markets, right? So we trade 55 markets, and of course we could trade a few more. But I also remember from from my conversations with my peers over the last 20 years, I mean, a lot of them think that once you get to 60, 65 markets, there aren't that many that are really that, diversifying for you. But anyways, my point was slightly different when I kind of said the point about you also need to have conviction in your portfolio. And that is, one of the things we were discussing was that I don't believe you can keep adding more markets and trade them with the same level of risk. That's the point. I think if you have 100 markets, you need to trade smaller compared if you're having 50 markets. That's my belief. I don't have any statistical backing for that, but that's my belief. And that's why I'm saying sometimes we also don't have to be afraid of having conviction in the portfolio where we have maybe fewer markets, but where the exposure is a little bit bigger, because otherwise we're just going to end up looking like, average, right? If we just make, that's, I just want to say that before you give your final verdict.
Maybe one thing before you start, Rob, and then you can answer that question at the same time. Obviously, if you have the same amount of capital today and you're doubling the number of markets, then yes, you need to trade them with less risk. But let's just assume that we're talking institutionally sized, like $1 billion or so portfolio, right? You can really go across all those markets, I think. And the extra costs, I mean, well, I don't know how people are doing it, but for me, the extra cost of another market is really zero.
Okay.
It's traded automatically. I'm paying market data cost anyway, right? Maybe that market that I will be adding is less liquid than the ones that I have in my portfolio, so it may have a little bit of more transactional related cost. But other than that, it is just not there. And the final point I want to make is that with our style of trading, I think there is a second dimension to that diversification that you do not see in a long-only type of portfolio. If we're long-only buy and hold and we're putting equities together, right, like the 51st stock isn't going to add as much as the 50th and so on. But we don't know where the trends are going to be. The more markets we trade, the greater the probability that we will catch one of those trends. We don't know where the trends are. It's not about just the diversification that the daily returns are uncorrelated to each other. It's we're trying to increase the probability spectrum of getting on a ride on some of those markets that have a massive trend and hopefully takes us to the moon to pay for all those losers. And the more markets I trade, the greater that probability is.
Yeah, I mean, there's kind of a quantitative way of describing what you said, Moritz, which is that if you compare the correlation of a trading system with the correlation of the underlying assets, it's less. So obviously, if you've got a really slow trend following system, then it's going to have quite a high correlation with the underlying asset, especially if that asset has got a lot, a big secular trend in it, like, I don't know, euro dollar. The last 40 years, a really slow trend following system would have been pretty much long the whole time, maybe briefly a couple of times short or net flat, but it's going to have a correlation probably about 0.9. If you've got a really fast trend following system or doing something even weirder, then it's going to, the correlation between that and the underlying asset is going to be much lower. And if I compare two really fast trend following systems, even on two assets that are quite highly correlated, like say, I don't know, US 5-year and 10-year bonds. So US 5-year and 10-year bonds, long only, the correlation is probably about 0.95. Our kind of medium speed trend following, you can get that down to about 0.6, 0.7. So mathematically, there is a greater return to diversification. I think the compromise would be, and it's an idea I've been thinking about myself, if you have a system which scales position according to conviction, which is what I call forecast scaling, and in trend following that would be something simple like, the stronger the trend is, the longer or the shorter you'll get. You can kind of introduce a threshold, which basically means you don't take positions if that conviction level is too low. And what that means in practice is you can have a very large portfolio of markets that you're collecting data for and monitoring, but it might be that only on about a third of those at any given time would you actually have enough conviction to hold a position. So it might be that your theoretical portfolio has 150 markets in it, but only about 50 of them do have the conviction and do have a decent sized risk. Now that's going to be particularly valuable for people with sub-institutional sized portfolios, because it means they can get a lot of the benefits of having a very large portfolio of markets, but it might be that they only have to hold a dozen positions at a time. So that's one way of doing it, to kind of bridge these two worlds. But if I'm being honest, once we kind of push the practical issues to one side, and I should say, Moritz, that the markets I was talking about earlier with the practical problems, those were actually OTC markets. So, the costs perhaps are fixed costs are there, which perhaps wouldn't be for futures necessarily.
Fine.
Yeah. But I'm kind of probably, to be honest, more on Moritz's side than on yours, Niels, to be honest. I think, as a rule of thumb, all of the things being equal...
You can always come back.
All the things being equal, as a rule of thumb, you should have as many markets in your portfolio as you can cope with.
Yeah, no, I mean, again, I think from a theoretical point of view, I fully understand it. When I look at real data from managers, I'm not so sure I see the evidence, but, that's fine. But actually, I think you make a good point, right? Because since I know a little bit more about Moritz's system, he knows about our system, we are the longer term guys, right? So, compared to what he's doing. So there may definitely be some more benefits for him to do so. So yeah, no, I mean, great. This is one of those topics that often comes up, and we loved, hatching it out from time to time. So let's do that. Moritz, why don't you take us somewhere else in your thoughts and more about diversification, or a completely different topic?
Well, maybe let's change topic, because we've got so many topics, Rob. We could probably speak to you for 3 hours today, and maybe we have to split the episode if it takes too long, which is fine. But maybe remind us, I mean, what do you trade? I think you've mentioned you have a long-only stock and bond portfolio, you have a trend-following system, but what type of other strategies do you have? I mean, do you trade mean reversion type of systems? Do you trade the VIX? Do you, I don't know, do you trade options or linear instruments? Tell us a bit about what it is that you do.
Yeah, so I have a long-only stock and bond portfolio that's implemented through ETFs. And that's a kind of classic kind of tactical asset allocation system. So, and it's using basically momentum for the sort of asset allocation side. And then within asset classes, it's based on fairly simple value measures. And that's, geographically spread, as you can with ETFs, across a lot of different countries, and, within bonds across different credit qualities and currency exposures. I then got a UK stock portfolio that's basically, I would describe it as a kind of mixture of value and momentum. So I use value filters to select stocks, and it's kind of forced to be diversified across sectors. But then the exit is a momentum base, so it's effectively just a stop loss. And interestingly, a week ago I had a dozen of the stocks in this portfolio, and as of yesterday I have 0, because every single stock got hit. So that's kind of interesting. And then the more relevant and interesting part of my portfolio is fully automated. So the other two portfolios are systematic but not fully automated. The stops are, but the entry isn't. So I've got a fully automated futures portfolio spread across all the major asset classes. I do trade the VIX. I also trade the European VIX. The actual V-stocks, yeah. The actual sort of breakdown of styles within that is probably roughly around 50% momentum, about 40% carry, and 10% mean reversion. So if we go back to Niels' favourite split of convergent and divergent, that's pretty much 50-50 convergent divergent. And because I'm trading my own money, I'm not limited by sort of institutional constraints. So, my previous job, there's no way I would have been allowed to have had this much divergent stuff, because that's not what the client was looking for. We were looking at portfolios that were 70 to 80% momentum, and then 20. The other 20%. 30% could be the carry and the mean reversion stuff. So yeah, it's fairly diversified. It's diversified across time frames as much as I can, and the way that sort of enters in is that during the fitting process, I generally speaking can't distinguish between the pre-cost returns of different momentum strategies for different markets, but obviously you have to consider costs. So what that means in practice is that something like Eurodollar, which is quite expensive to trade because it's low vol, I'm trading that pretty slowly, whereas some of the stock markets I'm trading more quickly. That slightly sort of goes against some sort of stylized facts in the industry, which is that fast momentum doesn't work so well on stocks. But the kind of statistical evidence in favor of trying to treat all markets equally before costs for me outweighs that particular effect. I don't trade options. I think it's fair to say I would like to trade options because my exposure to the kind of risk premium of options comes mainly through a sort of systematic bias to being short the VIX and short the V stocks. But I'm not getting any kind of relative value option premium, anything like that. Actually, in a former life, I was an options trader at an investment bank, so I do know the space. But it would be a relatively large amount of work for me to set up a systematic options trading strategy, and I would need to be really, really careful about things like execution. Whereas at the moment, I can be a little bit more relaxed about it. But if I was had a systematic short options portfolio that needed to be delta hedged, the potential for losses last week. I mean, you really had to have extremely high grade kind of automation, and that's not something I'm prepared to put the work into. So.
Yeah, or short variance swaps, which is the square of that vol.
Exactly, yeah, but that's a product that's only really available to institutional investors unless you do something crazy like buy a short leveraged ETF, which I'm not going to do.
Yeah.
So I saw you tweeting, I think yesterday or the day before, about getting ready to file your taxes in the UK, and that you had done really well this past 12 months. So what's worked really well for you, given that very kind of diversified type of approach to the markets?
Yeah, so the futures portfolio this year has done really well. So I tend to measure my performance on the UK tax year basis. That's roughly from April to March. So as of now, it's up about 31%. And my annualized vol target is 25%. So that's a sharp of just over 1. So that's pretty good. That's my best performance since I think 2014. So that's worked pretty well. Within that, things that have done well, it's been things like the metals. Palladium, platinum. They've done very well. Because I have more carry than most trend followers. I think the carry's done particularly well this year, and so coming to the end of my kind of performance monitoring period, if I just looked at the annual figures, I'd see 31% up in my futures portfolio. In my kind of long only stock and bond portfolio, I mean it's going to be perhaps down 20%, something like that. So just on an annual basis, I could say, yes, this has been a really good diversifying year for adding the trend following product. That's a little bit naughty though, because as we've already discussed, that's not really because the futures delivered the crisis alpha in the last couple of weeks. It's more that I was lucky to have done very well throughout the latter half of 2019. January 2020 I was up 9%, I think. February, I think I was up a couple of percent, and so far this month I'm flat. So it's more been a case of all the money being made and then hanging in there over the recent crisis, which is is obviously fine, but it's not quite true to say that the portfolio delivered crisis alpha just because on a year by year basis. It's still done very well. Most of that performance has actually come before the crisis has hit.
Yeah, and by the way, I mean, I love the person who coined the phrase "crisis alpha" and even wrote a book with her,
Katie.
I was exactly, and I was so I've said this before on the podcast. I was so excited in 2011 when this phrase was coined, because I thought, yes, finally, institutions have something they can gravitate to, and this is why they need us, right? Actually, have changed my mind on this, because now that's all they can talk about and that's all they can measure us against. And of course, I mean, our firm goes back to 1974. So when we designed our systems, we didn't design it with a crisis alpha in mind. I mean, that didn't exist. So I'm kind of, let's not get too excited about crisis alpha. Let's just produce absolute returns. And if we can do that with zero correlation over time, we're doing a great job, and we have a role to play in any portfolio, really. So
yeah, I mean,
but I wanted to...
Sorry, can I just on that point? It's just I think you need to think about common sense. You want to buy insurance against the market crashing. If you want perfect insurance, you're going to have to pay for it. So perfect insurance would be something like buying out of the money puts, and always buying them. Not buying them selectively when you think they're cheap. Over time, that will lose you money. That's a negative Sharpe ratio strategy. Trend following is something that provides less protection against market crashes, because if they're sudden and savage, then you won't necessarily get your insurance policy paying out. But it does seem to be something that has a positive Sharpe ratio. So it's kind of unrealistic to expect that you can have your cake and eat it. You can't have a product which will give you perfect protection in a crisis, but also make you money. That's ridiculous. If you're really that worried about a crisis, then you're going to have to spend a lot more money on buying your insurance policy and investing in something like a tail protect fund that will consistently lose your money until something like a couple of weeks ago happens.
I'm going to jump a little bit around. I'm sure Moritz will do as well. But it was just something that you said, and that I'm not sure whether it surprised me or whether I just seem to have a different memory of things that I've read from you or heard from you. Because you mentioned before, I think, that you don't trade the markets necessarily exactly the same way. And I thought that I had heard previously from you that it's a really good idea to trade all markets equal, so to speak. Can you talk to me? Because this is another discussions we've had, not necessarily because we disagree, but there's always this thing about, when you build, say, a trend following portfolio, and in our case, we trade all markets equal, even though we know that none of them is going to be optimal. I mean, we could find models or speeds or parameters that are better for certain markets. Of course, we could. We still choose to trade them equal. Talk to us a little bit about that conundrum and why you've chosen to go your way, and so on and so forth. And how, because we have both a lot of institutional and private investors listening to us, but we also have a lot of people who are trying to design their own systems, and this is one of the things that they will definitely be wondering about. What should they do?
Yeah, so I'll probably start in a more abstract sense, then home in on what I actually do with my own system. So I think human beings have a real tendency to love stories and to think, actually, every market is different, and every market should be treated differently, and that seems logical, right? It seems bizarre in a way that Aussie dollar should be treated the same as pork bellies. And I think another reason for that is that a lot of the institutional memory of people in the industry comes out of pit trading, where the guy who was in the pork bellies pit would be nowhere near the Aussie dollar pit, may even be on a different exchange, and he wouldn't presume to think that he could be kind of removed from the pork belly pit and then go and trade Aussie dollar in exactly the same way that he'd been trading pork bellies. That seems logical to human beings. That just seems like common sense. Now, to address this, in the book I wrote recently, I said, okay, that's the story, but what's the evidence for it? And I did a plot, and I said, right, for a particular speed of moving average crossover, what is the Sharpe ratio across 40 different futures markets, including pork bellies, including Aussie dollar? And there's this wonderful, compelling graph, and it shows a strong negative Sharpe ratio for, I think, the worst market is the Swiss stock market index. And at the other extreme, I think it's something like Italian bonds, interestingly, given what's happened recently, that have the very strong positive performance. I say, oh wow, it looks like common sense is correct, and that we should actually be making a decision here that only in some markets should we be using this momentum filter, because there's a lot of markets clearly where it does very badly. But then I say, well, now let's add an extra thing to this graph, which is the concept of statistical significance. So rather than just showing the mid estimate for the Sharpe ratio for a given market, I put around that error bars, which give us an idea of the sort of confidence interval that we can have, and we can basically say, yep, we can be 95% confident that the Sharpe ratio, which we know the average number for, we can be 95% confident it's somewhere between this lower estimate and this upper estimate. And when you add the error bars to this wonderful clear plot showing negative to positive Sharpe ratios, what you see is that none of those Sharpe ratio differences are significant, because all the error bars overlap massively. So there's actually about a 30% chance that the Swiss stock market index could be just as good, if not better, than the Korean 3-year bond, even though they're at the opposite ends of this plot. Sorry, the Italian 10-year bond, I think I said earlier. So, doing that kind of exercise really rams home to you that the human intuition that all markets are different is not really the case. And whenever anyone finds evidence for it in a back test, they probably haven't done this exercise of checking to see if the evidence is actually statistically significant. So my starting point is normally that the returns from a given system or a given market, whatever it is we're trying to fit across or optimize across, are the same. The Sharpe ratios are the same in expectation. But here's the caveat, and I think there's a bit of confusion about what I said earlier. This is on a pre-cost basis. So on a pre-cost basis, I believe that momentum on 10-year bonds in Italy is the same as momentum on the Swiss stock market index. I've got no evidence to suggest otherwise. Therefore, I whip out my trusty Occam's razor and say that the simplest thing is true. I can't distinguish my hypothesis. Blah blah blah. I'm going to treat these markets the same, but they don't have the same costs, and that means that although in principle you may think that a faster system should be traded with all markets, in practice that fast system is just going to be too expensive to trade for something like euro-dollar. So that's the only difference between again, it's the difference in theory and practice. In theory, I'd probably have all my markets trading exactly the same. In practice, there are some markets where faster systems are just too expensive, and therefore I have to reduce or even eliminate those from those markets. But generally speaking, I have seen some patterns that look convincing, like, for example, if you look at momentum and carry across the US bond curve going up from 2 years to 30 years, it does look like there's a pattern there. It looks like momentum's better at the short end and carry at the long end. But, statistically the evidence is weak enough that my preference is to keep things simple, keep things robust, treat everything the same before costs, and then bring costs into the equation.
Shame that Jerry isn't here this week. He would have loved exactly that point. We're talking about sample size a lot, and when we say that at the end of the day, prices are the result of human behavior, humans trading with each other, or humans programming systems that will trade automatically. But it has a human origin. And kind of like you should see it reflected in the same way in hogs or pork bellies, which no longer exist, as you would in the Aussie dollar. So therefore, let's just design systems that will treat them all in the same way. And the positive thing about that is that you get larger sample size. If you're doing, say a 200-day breakout in the same way across all markets, say you're trading 80 or 100 markets, then that it simply produces a larger statistical body of evidence that you can work with, and therefore larger and better statistical significance to come to a conclusion as to whether your system is worth trading or not. Now, if you have one market that's not trading the 200-day breakout, it's trading the 198-day breakout, the 199-day breakout, even though that's super, super close, technically you could say, well, I can no longer include that in my sample because it's really trading a different thing. So sample size reduces, and the quality assessment that I can make of that system is no longer probably as good. Now, the counter argument I have with that, and I think that's true first off, but one of the counter arguments that I could make is say, well, let's test the portfolio on the 199-day breakout, and you will get the same sample size, probably, or very close to the 200-day breakout portfolio, and it will show you results that are very similar, maybe identical even, right? Then we do the same on the 190, on the 180, on the blah, 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 all the other breakout type of levels, and we would find that they're all good systems. So if they're all good systems, and we would all trade them, why not diversify across those systems, which is kind of like what we're doing anyway, right? And then you could kind of like create a bridge into helping you to say, okay, some markets I'm trading with a 150-day breakout, and some other markets I'm trading with a 250-day breakout, maybe also in light of the costs which you have just mentioned, Robert, which I think are that is a practical truth. That is a factor that some of the markets are just more expensive to trade than others. So you can probably get away with that. And, we're still not at the point where I think we have a final answer on that. And probably as usual, there isn't the one answer. And there's many different perspectives on that. And people have to pick and choose what they feel comfortable with.
Yeah, I think we're very much on the same page. I'm definitely a fan of including as many things in your portfolio as you can, whether it be instruments, as we discussed at length, or diversifying across styles, and then within styles across time frames. Absolutely. The point about sample size is extremely important because we are limited in how much data we have. We're trading quite slowly, so we're not going to get a huge benefit by necessarily even getting 10 years more data to add to our 40-year backtest. But the difference between able to backtest with just one market worth of data and being able to backtest with 100 markets worth of data, so as a rule of thumb, statistical significance increases to the square root of the number of things you've got, whether it be years of data or markets. So you can have 10 times more data if you've got 100. You can have 10 times more statistical significance if you've got 100 markets rather than if you've got one, and that's just a huge difference. There's a slight conundrum here, which I kind of alluded to earlier, which is that you want to diversify across instruments, you want to diversify across time frames, but you can't necessarily do both in the way that you'd like to because of the cost issue. If I want to trade fast, I have to do so in a place where I've got less diversification across instruments because there are few instruments I can trade fast. There's actually an interesting problem in terms of how you deal with those. Do you kind of with those two problems? You've got to say, well, either I don't trade fast at all, which is reasonably valid, and somebody like Winton, I guess that's the route they've gone down. Or you say, right, I'm going to trade fast, but I know that I've got a limited set of instruments to do so, and therefore in that space at least I'm giving up some of the instrument diversification that I can keep at the slower end, where we're talking about 200-day moving averages. Pretty much everything can be traded with a 200-day moving average, but if we're talking about like a 5-day breakout system, then you probably can't trade that with something like Eurodollar because it'll just be too expensive.
Yeah, no, a very interesting challenge. Now, we had one question actually from one of the guys that came to the live event that we hosted last year, and that's from Seth. And he just asks whether we could just discuss a little bit about how you incorporate correlation into a trend following program. So again, obviously you trade 35 markets, you said, but what are your thoughts about correlations in terms of thinking about it in building that system or model?
So I sort of deal with it on two levels. The first is to think about the long-term correlation between the trading systems, and we've already discussed that, right? We've said that's generally lower than it is for the actual instruments themselves. So what you want to do is obviously measure correlation and use it to construct the most diversified set of portfolios you can do. So that means, for example, that you want to diversify across asset classes because they do have a lower correlation than, say, 5 and 10-year bonds. The trading systems themselves, as I said, not as correlated as the underlying assets, but they're still going to be reasonably well correlated. Whereas, a trading system trading lean hogs versus Aussie dollar, there's going to be quite a low correlation there. So those are two things you want to have in your portfolio. The same thing applies, actually, interestingly, with the question of speed. So 199-day and a 200-day moving average are very highly correlated. So as well as costs coming in terms of thinking about how you allocate across speeds, the other thing is that you want to have probably, ideally, ignoring all other effects, a bit more fast momentum and a bit more slow momentum and not so much medium momentum, because that medium momentum is going to be correlated with both the fast and the slow, whereas the fast and the slow are going to be more diversifying because they're kind of quite sort of spread out on the frequency spectrum. So you have this weird kind of effect that you want to have a sort of a U-shape set of weights allocating to speeds, a lot on the fast, a lot on the slow, not so much in the medium. But if you then apply the kind of question of costs on that, then obviously that's going to push you potentially out of the fast and into the medium and the slow. So that's the first thing. You want to use correlation as a guide to say, how you should spread out your assets and how you allocate across them, whether that be instruments or trading systems. But the other thing you then need to do is work out how much diversification you've actually got, because you're going to need to run your system quite differently. If you've got an awful lot of forecasts coming in, which are very uncorrelated, then the average forecast is going to be much lower because it's going to be reducing the standard deviation of your forecast. So you need to actually come up with a way of scaling your portfolio to compensate for that. And in my work, I call this the diversification multiplier. The idea is that as you add instruments and rules to a trading system, you kind of estimate this diversification multiplier, and the only thing you need to estimate is the correlation matrix and the vector of weights, allocation weights, and that then produces a single number that you can then just multiply everything by. So that means in practice that your system may be in a position where at times it's taking on a lot of risk, because although on average all of these correlations are potentially quite low, in peak periods, when forecasts are very strong, potentially you could be taking on a lot of risk. So that brings me to the kind of other dimension of using correlation, and I think Niels mentioned this earlier, and that's in terms of your kind of risk overlay. So I talked about the long term, about building a system that on average is uncorrelated, is diversified, about scaling the system up to compensate for that. But actually, as risk managers, we actually care about what our portfolio looks like today. Where are we long, where are we short, and what the current correlation is of those positions. I have a risk management overlay which kind of takes that into account. And if the portfolio is the estimated risk of my portfolio is currently much higher than I normally want, so my average risk target is 25% annualized standard deviation. If it's saying that right now these positions have a risk of 75%, then I'm going to leverage back. I'm going to reduce my exposure overall. So people often say to me, a common question is, how much data should I use to estimate a correlation matrix? And my answer is, well, that depends. What are you going to use it for? If you're using it to construct a system over a 30-year backtest, then there's probably nothing wrong with using that whole period to estimate the correlations, and certainly at least 5 years, I would say. If it's answering the question, what is the current risk of my portfolio, then you're going to need a much shorter estimate. I would say, perhaps maybe about 3 months, and ideally some kind of exponential weighting that gives higher weight to more recent data, because when things like last week happen, when correlation patterns shift, your risk measure adjusts to that and is able to say, well, yeah, actually, your long stocks and bonds, that's actually now much riskier So you really need to cut back your leverage to compensate for that.
Yeah, no, I mean, I couldn't agree more. I think that's really important. So thanks very much for that. What's on your mind, Moritz? We obviously want to be respectful of Rob's time on this Saturday morning. So, but I'm sure we can squeeze in a few more questions before we let him go. So
yeah, couple more. Also a listener question. Long-term listener shares the same name as me, Moritz. He's asking you how you go about changing your systems over time, and how you modify systems, how you detect decay, and obviously those are subjective decisions, I'd say, and it's the discretionary thing that even systematic traders need to admit that they're doing, which is fine. Is there anything else that you're doing on a discretionary basis?
I mean, in terms of changing the system, I try and change it as little as possible. I think there's probably a bias in the institutional world, at least this was my experience, towards changing systems too much. So if you say, well, I've got a 40-year back test, and I've now got another year of data, is that really going to change my mind very much? Is it, if I was to refit the system and then compare the parameters and say, well, they've changed, yes, but on a statistical basis, have they really changed that much? No, probably not. So ideally, I'd only be changing the system probably when I was introducing something new into it. So if I have a new kind of trading rule or a new instrument, that obviously means that the capital has to be redeployed. To be honest, actually, over the last few years, I've mostly been taking stuff out, and that's not been because I've joined the club of Niels and saying that fewer instruments is better. It's been exogenous things like the fees on market data being increased, and as an individual trader couldn't justify paying the higher fees. It's been actually, there is one perhaps more interesting example, which is when volatility has fallen too low in a particular instrument, and it was the 2-year German bond future, the Schatz, and the volatility had reduced to a level where basically the trading costs on a risk-adjusted basis were just exploded, and the size of positions required was very high, and there was potentially kind of tail risk there in that, although generally speaking the vol was very low, it could easily one day change and become very high overnight, something that happened with Swissy Euro back in 2015. So I decided to remove that instrument from my system until the vol had recovered to a level, and that I'd call that a kind of semi kind of discretionary decision, in that it's not like I have in my system an automatic kind of logic saying if vol is less than X, then position equals 0. It was more a question of me saying, well, the vol looks really low here, and it's a kind of qualitative judgment as to what point you cut it off. But I think once that judgment's been made, then you do essentially have a trading rule, because I said, right, if any instrument goes below this vol level, I'm going to remove it from my system, and I'm not going to introduce it until the vol goes back above a higher level. And although that's not kind of formally part of the code of my system, it's a rule I adhere to in a kind of external sense. I have a couple of times had to dial back my exposure in markets because the margin requirements increased very dramatically. So I'm running at 25% annualized vol, which is a bit higher than most institutions. So I do tend to use a bit more margin probably than most institutions do, and I had to cut my V stocks exposure in half a while back because the margin increased, and it just so happened that I had quite a big position on. Okay, so in an ideal world, I'd have some kind of fancy optimization that knew about margin levels and redeployed capital in the most efficient way. That's something that theoretically I could do, but it's quite a lot of work. So I took the more discretionary decision of saying, right, I'm going to cut my position in half until the margin level recovers to the point where I can afford to hold it again. But yeah, I do try not to meddle with my system. I mean, I bang on about it in my books and on my website and all the time, saying, do not override your system. So I do try and practice what I preach, and if I do override it, I sort of put my hands up and say, look guys, I have done this, but I believe there's a very good reason for it, but it should be a relatively rare event, definitely.
Yeah, no, I mean that's all very interesting. For me, maybe as a last overall topic that I just wanted to dig into a little bit. Moritz may have a few more, but given what we're going through at the moment, I think one point that is so important, generally speaking, whatever you do in the investment world, is risk management. I think that is something that we, it gets tested from time to time to an extreme. I think that's what we've been going through again the last week or two. And I wanted to ask you a little bit about what you think about it. What is, in your opinion, a good risk management framework? Because there are many different types of risk, right, in what we do. And maybe also some of the things you've learned along the way through the various crises or stress periods that you've been, trading through. What are the things that stand out? And if you can talk a little bit to that would be great.
I mean, one of the nice things about the kind of style of trading that we do is that most of the risk management's kind of done for you by the system itself. And that happens really through two different avenues. The first is volatility scaling, and the second is the use of a momentum filter. So in terms of volatility scaling, when positions get riskier, the system will automatically reduce the size of the position to compensate. So if you were unfortunate enough to be long S&P futures a couple of weeks ago, the VIX was at 12 maybe, and now it's at 70. So it's gone up by a factor of about 6. So all other things being equal, your position would probably have been reduced by a factor of 6. So you would have gone from being long 60 lots to being long 10 lots. And that's a purely automatic response, and that's regardless of any information the system has about what the future is going to hold. It's just that it's automatically reduced the position by a factor of 6. And the other thing, of course, is that if we're trading with momentum, or at least with a high enough proportion of momentum in our system, and even my 50% momentum is enough to get this effect, when positions move against you, they are automatically closed. So you don't have to worry about where your stop loss level should be, or the kind of size of move in the market that would lead you to close the position. Again, it's just an automatic, natural part of the system. For a long time, AHL didn't employ a risk officer, at least no one with that job title, because I guess one attitude was, risk management is everybody's job, and the other was, actually the system kind of risk manages itself, to be honest with you. So that's kind of the starting point, and then I think on top of that, I think it's sensible to add some overlays, and I talked about one of them already, which is this idea that the long-term kind of correlation of your system returns may be low, but there may be times when your peak risk is particularly high, because your positions have lined up a particular way, and just because market correlations have become more unusual. So for that reason, I think it's definitely worth having this kind of overlay in place. Now, a debate I've actually had with a friend of mine who works for a large US hedge fund was about this idea as to whether you should kind of completely go towards targeting a given level of risk on a day-by-day basis. In other words, saying, our risk will always be annualized standard deviation 15% a year in expectation based on what our positions are at the moment. So what I do is different, which is to say, on average, I'm shooting for a particular level, but it might be because of the strength of my forecast that I sometimes have less than that, sometimes have more than that. But if I have a lot more than that, then I'm going to be worried and kind of scale things back. I do think there's a benefit from scaling positions according to conviction of forecast, and I see strong evidence for that both in momentum and in, say, carry systems. And I believe that sticking to a fixed risk target, you kind of lose that information. But that doesn't mean you should scale back when risk gets really nasty. The other things I think about are kind of sort of pushing that risk management model and saying, well, what are the weaknesses of that model and how can we correct it? So I'm a firm believer in using a simple model which you understand the shortcomings of. So I do use, a fancy name would be a joint Gaussian model. Well, that's basically a model which assumes that a correlation, which is a linear measure of co-movement, can be used to measure co-movement. We talked about that already and the shortcomings of that. And also assumes that asset returns have a normal distribution, a so-called bell curve. Now, this is completely rubbish, right? I mean, everyone knows that both these assumptions are wrong. But the nice thing is that with such a simple model, is that there's nothing kind of hidden about what's going on inside it. It's very intuitive and understandable, and the shortcomings are very well known. And what I then do is apply essentially overlays on that model saying, okay, I know correlation's a really poor measure of co-movement. What if I stress the correlation matrix and assume that, normally stocks and bonds have got a correlation of about 0 or negative. What if that correlation goes really high? How does that change the current risk of my portfolio? Similarly, what if I sort of say, well, yeah, a bell curve normally is okay, but what if there's a tail event like we had last week? What if vols go to kind of the 95th percentile of the historical range? If I apply that stress event, what does the portfolio risk look like then? And that kind of works pretty well. I'd say it works as well as, if not better than, a more complex methodology, which would be something like saying, I've got a PhD in maths, and I haven't. I'm saying, you employ a kind of typical risk quant who would say, oh, well, I have a PhD in maths, and what we should do is implement a much more sophisticated risk model that has, high moments of the return distribution and has these things called co-skewness and kurtosis and blah, blah, blah. And it's all very complicated, and nobody really understands what's going on inside it. And these models actually tend to be not very robust to the data you put into them. So if you take out the 87 crash and put it back in again, the estimates of risk can change very dramatically. Whereas, I would take a more kind of heuristic approach, which is to say, will my portfolio survive a hypothetical repeat of the 87 crash? Yes or no? I think that's an easier to understand and also more robust approach to risk management.
Yeah, no, I completely agree. I think it's super interesting. One thing actually that I wanted your opinion about before, I'm sure Moritz might ask you a few more questions, is just the whole concept of AI. I mean, I'm super curious to see how AI models have gone through the last 2 weeks, because this is data that those models probably wouldn't have seen before. Do you have a view on AI? Do you like it? Do you hate it? Neutral?
I mean, I think it's fairly well known that I'm not a big fan of AI. I kind of put my cards on the table and say, partly that's down to ignorance. It's not a space that I understand that well. It's also partly down to the bias of having seen people use, these more complicated techniques, so things like AI, machine learning, neural networks, genetic algorithms. I've seen a lot of people do some very kind of massive degree of overfitting using these techniques. And I think the real danger is that there are most of the people I've seen using them do not have a good kind of robust background in sort of classical statistics that underlies them. And they don't really have a good intuitive understanding about, robustness and overfitting. And so they use these models, and it's like giving a 3-year-old, a nuclear weapon. It's just dangerous. Now there are people in the space who really know what they're doing and are using AI very intelligently. But you go and speak to these guys, and it's obvious that it's a fearsomely complicated business. The kind of person off the street who's downloaded some kind of open source, machine learning library and has applied it to financial data and thinks that they're going to become a billionaire is almost certainly in real trouble. So, my kind of understanding is that a lot of the funds that are using AI are using it less in the kind of core alpha generation, and more in more specialist areas like, for example, trade execution. Because it's something like trade execution, you have a lot more data, and therefore there's much less chance of overfitting. I don't think there are that many, big players in our industry who are using AI in a really big way. I think they're experimenting with it, they're playing with it, and there are certain areas of the business where it's definitely very valuable. But it would be very, very interesting to see how the numbers come out at the end of this month. I mean, we've talked about our own performance. I think you're going to see some really big dispersion. I know of people who were making like 14% on some days last week on a single day in this space. And there are going to be others who are losing that kind of money. The average is probably going to be pretty close to flat, but I think you're going to see some pretty big dispersion, which goes back to our earlier discussion about the correlation between different funds being quite high, but actually you can have weeks like last week and the performance can be really quite different.
I fully agree. We simply, we've mentioned that before, we don't have enough data for most of our systems if we're using daily bars, right? And like you say, Robert, if you're doing something in the low latency space or in execution, then there's much more data that you can work with, and then maybe machine learning or AI type of techniques, they can be effective there. I've also said that I'm not smart enough to really comment competently on any of that. I'm not using it. But what I also want to say is, I haven't seen any track records yet. We hear people saying, "Oh, I'm using highly supervised machine learning techniques." I don't know what that means. To what extent is it supervised and to what extent is it not? Or it's integrated into the portfolio. Well, that's fine, but what role does it really play? Is it really marginal, or does it play a large role? So I'd like to see, and maybe those records exist and then I just haven't discovered them yet, but I'd like to see the evidence of, the pure machine learning AI type of fund with a couple of years under its belt and how it's been performing. And I'd like to contrast that to other strategies available to us that we have more ease of understanding.
Yeah, and that's going to be tough because I'd probably say that, in my opinion, perhaps 3/4 of the funds saying that they're using AI machine learning aren't really. They're just doing the stuff that we've always done, but they're labeling it as that because they think clients will be impressed. So, to actually get those figures, you're really going to have to dive under the hood and kind of get specific strategies that are being used and back test them and compare them. And that'd be quite a hard exercise to do, definitely.
And until then, I'd say it probably is a lot of marketing and a lot of hype, and it's one of those buzzwords together with the blockchain and all of the things that you kind of like want to mention if you are a quant fund these days. Anyway, maybe final question or second to last question, back to the simplest stuff that we do, trend following. What's your view, Robert, on trend following being potentially crowded and the returns of the strategy decaying or diminishing over time? As we've heard, you've mentioned the name Winton. Winton has been publicly out saying that they expect trend following returns to be weaker going forward than they have been in the past. Would you agree with that, or is it impossible to tell, too early to tell? I don't know.
It's definitely too early to tell. Because we need a lot of data to fit our strategies, because they only exist at the kind of bare threshold of statistical significance. A few years of poor performance is certainly not enough to kind of prove one way or the other, or at least prove with some kind of 95% confidence interval that the performance really, going forward is going to be much lower or negative. There's different ways of looking at this. One way is to say, well, where do the returns come from? I'm in sort of the kind of behavioural finance camp. I think it's sort of a psychological bias that people just don't like the style of trading where they're taking small losses and holding on for bigger gains. People like taking profits. The other thing to look at is, what's the AUM in the sort of trend following space versus the total AUM out there. That number fluctuates over time, but I'd say it's probably maybe 10% at most of kind of actively managed money, probably less. Now, that doesn't mean to say that there are markets where a bit much more than 10% of the volume is being done by trend followers. Although, actually, let me be a bit more pedantic. Because we trade quite slowly, it's quite likely there are markets out there where a reasonable percentage of the positions are being held, the open positions are being held by trend followers. But because we're trading quite slowly, that we're probably still quite a small fraction of the volume, I would say. Now, that doesn't mean to say that there will be times when a particular trade gets crowded, particular position gets crowded, and with a lot of people who are all doing a similar kind of thing. And I think one of the more interesting concerns is the growth of the risk parity industry, because risk parity funds, when it comes to a shock that causes you to exit your position, look an awful lot like trend followers, because as we discussed earlier, the thing that gets you out of your position quicker is the volatility scaling, not necessarily the momentum filter. So a big risk parity fund that doesn't use momentum, if there's a vol shock, they will be reducing their positions, and they'll be doing so in a way that looks very much like the CTAs, and you wouldn't be able to distinguish between them on the sort of trade level data. And there are, of course, plenty of risk parity funds who are using momentum, usually slower, but momentum filters to as a tactical overlay on top of that long-only position. So there will always be times when there's a market and there's a rush for the exit and it crashes, and people will blame it on trend followers. But I don't think that the size of the industry now, and I think realistically in the future, people just do not like this strategy, right? They just
that's a fact.
They just don't like it. It's kind of the blessing and the curse of the industry, right? The curse is that people just don't like it, which means it's really hard to sell. It doesn't have a kind of blockbuster shot ratio. It may deliver quote unquote crisis alpha, but not always. It's really hard to tell a compelling story about it, compared to, say, telling a story about kind of an exciting human stock picker who really has a massive expert on this particular thing. You can tell a great marketing story about that. It's much harder to tell a great marketing story about a bunch of guys sitting in front of computers playing with programming languages. But the blessing for that is that the industry will probably never get big enough that crowding would really be potentially a serious issue. And the other aspect, just to finish, is that crowding means something quite different in momentum than it does in a mean reversion relative value or carry-based strategy. So when you get crowding in that kind of strategy, you get the effect of value compression. So if a whole bunch of investors buy, stocks that have got a nice price to book ratio, then price to book ratios will get compressed, and the returns available from that strategy will reduce. That won't necessarily happen with momentum. With momentum, if a lot of people pile into the same trade, it becomes self-reinforcing, and actually the returns from the trade increase. Of course, then you still have the problem that everyone could rush for the exit at the same time, but that's equally a problem with the value-based trades. And importantly, another important difference is that those value-based trades tend to have higher leverage because they're relative value, in many cases in the equity space, and in say FX carry space. When those yields get compressed, then volatility tends to fall. You get much higher leverage. So the kind of effect of the rush to the X's is much more pronounced in those style of trades than it is in momentum. So yeah, I don't think I'm ever going to see enough evidence one way or the other that momentum is working or not working. I kind of justify to myself that it has this psychological underpinning. I don't really know whether that's true or not. I guess we'll never know. But I like the characteristics of the strategy. I like the. I don't believe it will necessarily deliver crisis alpha, but I do believe that in the long run it will be uncorrelated. And I like the fact that it, as I've already said, it's easy to risk manage. And the way that the portfolios are constructed with things like the volatility scaling, the diversification, theoretically, that all makes sense to me, and that there's plenty of evidence that all of these things individually kind of make sense. So actually, even if momentum doesn't work that well, the fact that you've got a portfolio that's diversified and has got volatility scaling will actually generate pretty decent returns, because it is still going to be picking up on the risk premium from the different assets, and doing so in a way that with the risk management makes sense.
I mean, I love everything you said about that, Rob. And I would add to that, the other thing I really love about the strategy is that it's super liquid, even though, of course, we all know that private equity guys still have a ball right now because they don't necessarily have to market their positions for the last few days. So it looks pretty stable. But we all know that not being able to get out of your positions when you want is devastating. So, yeah, I mean, liquidity is another great thing. And actually, while you were talking about the fact that it's so difficult, people don't like the strategy, even though it's good for them. It reminded me about when my kids were small, and you had to give them their medicine or whatever it is, and they know it tastes awful, so they don't want to take it. But on the other hand, we all know that it's the best thing for them, anyways.
I mean, can I just quickly on the liquidity point, actually, because one of the things we saw in 2008 was actually CTAs did very well, and then we were faced with a wave of redemptions, because it was one of the few places where people could get access to we were offering funds with daily liquidity. We weren't putting down gates or anything, and people were like, great, this is the only place I can get cash. So it's going to be interesting to see whether we get a similar thing happening this time around as well.
That's right.
Anything else on your mind, Moritz? Otherwise, I just want to run through maybe where we stand.
Yeah, it's probably a good time to run through the markets and close this up. This has been fantastic.
We're going to twist Rob's arm to come back soon. But anyways, let me just quickly run through, where we stand as of Thursday evening. I actually think Friday was another big day. Friday, lots of moves in the market. So I have a feeling that from a CTA industry point of view, it's going to be a mixed day. Some people did well. Some people lost a little bit of money. But so the B Top 50 index, which is the 20 largest CTAs open to new investors, is down slightly this month, 1.93%. And down about 3% for the year so far as of Thursday. The SocGen CTA index is down about 40 bips for the month, and down about 1.1% for the year. Then comes the trend followers. As of Thursday, they were up just slightly less than 1% for the month, and up 1.37% for the year. The SocGen short-term traders index, as expected, doing well, up 1.21% for the month and up 4.48% for the year. And the Bridge Alternatives Index doing well, very strong this month, up 3.46% for the month of March, and up 2.73% for the year. For those who are curious about, Rob's books, let me just throw in there that they are in my ultimate guide of the best investment books you can read. So if you go to toptradersunplugged.com, there's a little banner in the top where you can download for free this guide, and you'll find Rob's books in there. They are definitely really good reads, and you should go and get them, and find any other information about Rob that you can listen to. As you can tell from our conversation today, there is a wealth of knowledge and experience that we can all benefit from. Moritz, anything else from your side? And Rob, anything else that you want to bring up that we forgot to ask you about, so to speak?
No, but thanks very much for being on with us today, Robert. That was great.
Yeah, no, it's been a very interesting discussion, and I guess the main thing I've been saying a lot on Twitter is that the nice thing about having a system is that when these things happen, you have a plan in place, and you know what to do. Otherwise, you have this kind of constant anguish about, should I sell anything? Should I sell everything? Is this the sell-off finish? Should I start now trying to find the bottom? What shall I do? It's very, very stressful in that situation, trying to decide what to do. Although this system may not end up doing as well as my decisions, hypothetical decisions could have been, I know that in the long run, it's definitely a more relaxed way of managing your money than the other way. And I, Moritz said earlier he wasn't intelligent enough to understand the AI stuff, and I'm in that camp too. And I definitely know that I'm not a good enough discretionary trader that I can kind of live through last week and make good decisions. I would have probably either been paralyzed or just done too much and probably ended up in a much worse place than even buy and hold. So yeah, it's even if trend following is not your thing, I think having any kind of system or plan in place, even if it's just literally buy and hold and do nothing, is better than the alternative for pretty much everybody.
Yeah, no, I couldn't agree more. Having a plan, having a map when you travel, also when you do your investment journey is super important, and that's how you survive and thrive in the long run. Now, just a quick word at the end. I mean, as usual, if you feel that you got any value from our conversation today, we certainly wouldn't mind if you would share this episode and maybe go to iTunes and leave a rating and review, because it really does help other investors discover our little podcast. From Rob, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.